Okay, let's get started. Good morning, everyone, and welcome to today's Tuesday Market Outlook session. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play, and today I am going to be walking you through how I am viewing the current market. So there's quite a lot to get through today, and before we get started, just a quick disclaimer. The types of securities, funds, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. So for our agenda today, we'll be starting off with the major indices. We'll be highlighting the Fed interest rate hike probabilities as well, and seeing where equities could move due to Fed interest rate hikes that we see for the next two meetings. From there, we'll be moving on to fixed income, commodities, and crypto. We'll take a look at the sector rotational model. As you know, there's been significant rotation over the last month or so. So it's always good to get a higher level view of where that rotation is happening. We'll view some subsectors of interest that I have for you today. I think I have 3 or so for today. And we'll end today's session with some bullish and some bearish market observations. So starting off with the Fed hike probability, and we know how sensitive markets are to the Fed right now. The Fed is looking at inflation as the most when it comes to interest rate policy. So I do want to take a deeper dive into the interest rate hike probabilities, not only for this month, but for the next meeting as well. So we have 2 meetings here. This is the 27th of July in a couple of weeks or less. And then we have the following meeting on the 21st of September. And this tells us the probabilities of where the target rate will be by those meetings. So right now, the current target rate is 150 to 175. That's the range. And what this tells us for the 27th meeting is that there is currently a 66.8% of rates being 225 to 250 basis points. That represents a 75-point hike. And, that definitely has been priced in my opinion. But what's important to look at is how it's changed over the last days or weeks or even the last month. So if we take a look at the table below, we have there was a 92.4% of that 75-point hike. That has now decreased to 66.8% just from a week ago, because inflation numbers came out, I believe, on the 13th of July. So this is pre-inflation numbers. So we have seen a significant shift downward for a 75-point hike and a significant shift higher for a 100-point hike. And that was a week ago, that was only 7.6%. That is now 33.2%. That being said, for the next meeting, I think, myself included, but I think a lot of the markets are essentially pricing in that 75-point hike. We don't think it'll be a 100-point hike. And you have seen that in equities, ever since the CPI data came out, equities actually managed to rally quite well over the last few days. So a little bit of ambiguity, but I do think markets are essentially pricing in that there will still only be a 75-point hike. That being said, what I found quite interesting with this chart was the 21st meeting, September 21st. So if we take a look at the highest probability range, it's the 303 to 325 point range. So that would represent 150 basis points. So if we get a 75-point hike there, we'll get another 75-point hike before the September meeting, which will leave us with 300 to 325. So fairly stable in terms of rate hikes, but in my opinion, that has not been priced in. And the reason I say that is because if we take a look at this number, 275 to 300, representing a 125-point hike, that is at 30.7%. And if we look at a week ago, that was at 62.8%. So right now, for over the next couple of months, the Fed futures are essentially pricing in an extra 25 basis points ever since that last CPI data report came out. And, that's where I kind of saw a bit of ambiguity with equities, because equities actually managed to rally since the data came out. And for that reason, I do think there's potential weakness here, or potential cause for concern. The fact that that extra 25-point hike hasn't really been accounted for, hasn't really been priced in. And also the fact that inflation has not yet really peaked. We still don't have the number that is coming in below expectations. It still came out red hot last week. So I do still have some concerns from a macro perspective for equities, and a lot of it is because of these the rate hikes not really being priced in. The 300, 325 probability was only at 34.7% a week ago, now at 51, whereas the 325 to 350 point range, which would represent 175 point hike and 175 point hike and quick maths there, 175 point hike and 100 point hike. That was at 2.4% a week ago. That is now at 18%. So still not too concerning, but this number here is definitely more concerning for me, that extra 25 point hike that has not yet been priced in my opinion. So if we take a look at the major indices here, we have S&P, overall strong bearish trend. And more recently, though, we have seen price start to stay above the key 380 level. Yesterday, Apple did announce that they were going to be slowing down the hiring process, which did see a significant decline towards the end of the day. But price is now managing to still maintain above 380. Overall, fairly neutral, very choppy, and in my opinion, still very difficult to trade. While I do still maintain my neutral to bearish view on equities, and that's simply because of, again, the macro risks that we have. We have recession fears, we have obviously inflation, and maybe even potential for a more aggressive rate hiking policy that hasn't really been priced in. So that being said, price is staying at elevated levels. So let's see, for the next key resistance area, that would be at around 404 if price were to rally from here. But if price breaks below 380, I'll be looking for a move back down to that 362 level and potentially even lower to that 50% fib retracement level at 350. That's where I see a major support level. But overall, it does feel like the major indices could potentially move just maybe one more leg lower here in this bearish trend. It still is maintaining a bearish structure defined by lower highs and lower lows, and it's still struggling to break above that 390 level. So if it does break above 390, keep an eye out for 404. But if it breaks below 380, I'll be looking for those two targets, around 362 and 350. Moving on to the NASDAQ. So similar in terms of price action, strong bearish trend, but price is definitely being capped at around just above that 293 area or so. 300 is a key area to also look at, and its 55-day exponential moving average is now catching up to price, which could provide dynamic resistance. If you take a look at the weekly time frame, we have seen a strong move higher, a strong move lower, followed by a lot of choppiness, right, at current levels. So it does look like, the bearish structure is still remaining intact, especially with price really unable to break to the 300 area. The one thing I will say is we are seeing a bit of positive divergence, and this is a very bullish indicator. We are seeing that while price is making lower lows, momentum is not confirming those lower lows. It's actually making higher lows. That's a very bullish indicator from a technical perspective. And that's where I see a lot of ambiguity with equities right now. And it's actually difficult to gauge where they might head, because on the macro side of things, it's definitely a more negative outlook with recession fears and, inflation and everything that I mentioned before. But from a technical perspective, the fact that price is managing to hold on to these levels and from the major indices and stay somewhat elevated relative to 3 weeks ago, along with the positive divergence on the NASDAQ, that might be a strong enough technical catalyst to actually break above that 300 level. So definitely something to keep an eye on. But right now, I do think it's one of those times where you just may have to sit on your hands a little bit, or maybe trade very less compared to before, because there's too much ambiguity and too much contradiction, in my opinion. Small caps, IWM, the Russell 2000. We are seeing price now back above that 170 key level, which is a 50% fib retracement level, but overall, not so much upside momentum. Price is really struggling to break above 175. And overall, we're not really seeing that outperformance in small caps that we potentially were starting to see relative to large cap names. But still, price is maintaining above 170, potentially maybe forming a base. That being said, if price breaks below 170, I'd be looking at 163 as a potential downside target, very short-term move there. And if it breaks below that, the 61.8 level at 153 would be the secondary target to the downside here for IWM. That being said, if it manages to break above 175 and its 55-day exponential moving average, which has provided resistance in the past, I'll be looking at the 188 area, which is a 38.2 retracement level as well on the weekly time frame. Moving on to the VIX very quickly. So VIX is grinding lower, managing to stay below 30, rejecting even 28 over the last few sessions. But again, let's see if it can manage to move below that 24 level. Because even where the VIX is currently at, it's still at fairly elevated levels, which means more correlation between equities, and kind of throws individual technical and fundamental analysis out the window for the short term, because this is so much systemic risk and so much systemic correlation. So that's really the reason I'm looking at the VIX, is to really see if it can break below 24, and that would be the start of indicating better trading conditions. Makes them a lot more easier to diversify. But for now, it's grinding there. Let's see what happens over the next few days. Moving on to yields. So we have the US 10-year yield. It has pulled back after that inflation announcement 2 months ago, or the June inflation announcement. And we are seeing it kind of settle down with 270 basis points acting as a base, which I do think will be a strong base, but not really being able to move above 320 basis points as well. So this is a range now for yields. And, if we take a look at TLT, the bond ETF, how it's impacting bonds, we are seeing bonds starting to consolidate below this resistance level at 117, between 117 and 120. Bonds are really, TLT is really struggling to really break above that, finding some resistance with the 55-day exponential moving average. Overall, a lack of momentum, but I don't really see a lot of downside momentum. I think it's just going to be fairly neutral. And unless we see yields start to pick up once again, we could see TLT revisit that 108 level. But for now, still a bearish case here for bonds and for this TLT bond ETF. Moving on to gold. So, last week we highlighted the strong breakdown in gold, and with this 157, 158 acting as a potential downside target. Over the last few days, it actually did manage to reach that level and bounce higher so far. It's set to open a little bit higher this morning. So that is acting as a good support level. And the short-term price movements here for gold is really being dictated by the dollar. And the dollar is extremely strong right now. That being said, it has pulled back from reaching an overbought condition, which is why we are seeing price respect the support level for now. Gold is a safe haven asset, but that's more of a long-term safe haven asset, whereas in the shorter term, its price movements are dictated and are inversely correlated to the US dollar, which is still exhibiting a lot of strength. That being said, we are looking at the euro starting to appreciate in value slowly, simply because the ECB are now starting and will most likely raise interest rates, I think this morning or tomorrow. But they are looking to increase interest rates and finally starting that journey. So we may see the euro find some support against the dollar, which would mean that the dollar index would actually move lower, because the euro has the highest weighting relative to the dollar in the dollar index. So in the basket of currencies, the movements within the euro matter the most, and the yen as well matter the most for movements in the dollar. Moving on to oil. So USO here has still actually managed to respect this range. We saw initially some weakness, a bit of a breach below that 71 area of support. The price has managed to recover and is now back in this range. For USO, 82 would be the next key resistance level. I don't really see it breaking above 82 anytime soon. On the supply side, we do have a lack of supply with Russia and, with just basically everything that's happened over the last few months. But on the demand side of things, we now have we have recessionary fears. We have lockdowns in China as well due to COVID, especially in the Shanghai region. That's a huge business hub. So that has definitely seen provide a bit of a catalyst for USO and for oil to actually move lower here. But what I take the most out of this chart is the exposure towards energy names. We know a lot of oil companies and a lot of energy names are highly correlated to oil prices, naturally so. And right now we are seeing a lot of momentum lost within that energy sector, which was the best performing sector in 2022. So right now, I don't really believe energy is a good bullish bet just yet. We're not really seeing that momentum or that upside momentum here in oil to warrant a bullish bet here on energy. That being said, it does have support at 72. So for short-term trades, there's some potential, but I'd struggle to see why it would break above 82 unless we see a significant shift in the supply and demand relationship for oil on a global scale. Bitcoin. So yesterday we actually saw some life in Bitcoin finally. It managed to actually move higher with some decent momentum, along with a lot of other cryptocurrencies. But already today, that momentum seems to be fading away. Still struggling to break above that 23,000 level, and overall just a lack of momentum. That being said, we are seeing price finding support at that 78.6 per retracement level. And despite really hot inflation numbers last week, it actually managed to hold on to this area as support. So this does seem like a very strong area of support. Maybe it would probably need a fundamental catalyst for price to break below that. And the next key area from there would be at 12, all the way at 12,000. So it'll be a significant decline for Bitcoin if that does happen. But for now, we are seeing that area of support hold. Overall, very neutral price action though. Okay, let's take a look at some sector rotation. We have 3 sectors in the improving and leading category. We have 8 in the lagging and weakening category. A lot of momentum lost in energy from the leading all the way into the weakening category. Not outright bearish, but definitely not bullish just yet. We'll have to see what happens within that sector and within oil. Healthcare managing to stay in that leading category. It is living up to its more defensive name. We have utilities and staples, utilities struggling with higher rates, but still providing decent defense in my opinion, and so are staples. Definitely not ones to write off, given the uncertain times that we're currently in. Technology showing very good rotation now out of lagging and into improving. I had my doubts about technology, especially with if inflation numbers did come harder than expected. How well would technology be able to cope? So far, decently well. So let's see what happens with technology over the next couple of weeks and where they can actually improve into the leading category. Communications as well, showing some decent momentum, but surprisingly discretionary. By far for me, the most bearish sector that I had for almost 6-7 months now, and we are seeing a lot of momentum back into that sector. But we will take a closer look here on this chart for discretionary. So overall, for discretionary, strong bearish trend on the daily time frame. And the reason I haven't really shifted my bearish outlook for the sector, I may have shifted from bearish to neutral, but definitely not bullish despite the momentum that we're seeing. And that's because of this resistance level just below 150. We can see here on the weekly time frame, especially, so far price is really struggling to break above that area over the last few weeks. And even though it has experienced a bit of momentum to once again retest that level, it did fail on the retest yesterday. So, overall, it's the fight between staples and discretionary is kind of like a fight between needs and wants. And right now, given high inflation numbers, it's expected to see rotation out of discretionary and into staples. We have seen a short-term rotation out of staples and into discretionary and into growth names. I don't really believe the macro environment would warrant that rotation being there for a long time. So for now, I'm maintaining my neutral to bearish view here on discretionary with 133 as a potential downside target acting as support. So taking a look at some subsectors of interest, we have the airline ETF JETS, and pretty interesting price action over the last few days. Overall, in the weekly time frame, we have seen a strong bearish trend, despite the reopening, which is somewhat concerning, but I don't think there's that much more downside. If anything, I think price will actually be able to, stay within range between 16 and that 1750 level. So we did see rejection of this resistance level once again yesterday, and even the price is set to open up a little bit higher. This sector or this industry is really struggling with, again, higher fuel costs. There's only so much that can be passed down to the consumer, and they're not really being able to reap the rewards of this full reopening. So for that reason, I'm still maintaining a neutral view here for JETS, and I'm playing the range between this resistance level and a very short-term downward movement here for 16 acting as a support level. XHB, the home builders ETF. Now, I know I sound like a broken record here, but I'm still kind of bearish on the in this industry. We saw a break below 60, a lot of bearish momentum, and we are seeing price managing to recover, but once again rejecting that $60 level twice in the last 5 days. We had an earnings announcement from Lennar a few weeks ago, which did provide a catalyst for that upside here for home builders. But we are seeing that momentum decrease here, especially with price also finding resistance at the 55-day exponential moving average. So my view here, my neutral to bearish thesis is really dependent on the $60 level acting as resistance and holding price below that level. And potential areas of support would be at 54, if not even 52. And at the 50 area as well, that had the pre-pandemic drop level could also act as a very strong level for the home builder ETF. Looking at KRE, the regional banking ETF, just a quick update on this one. So we did see, despite that, what was looking like an initial breakdown, and breakdown and potentially move lower to that 53, 54 level, price managed to recover. There has been some fairly mixed earnings. JP Morgan didn't really react too well for earnings, but a lot of the other names did. Citi did. A lot of the banking stocks have been moving higher over the last couple of sessions. That being said, we did see a strong rejection here of the $60 level, and I do think there's still potential for another downward move, potentially overextended after an earnings announcement. And I do think that, with the next area of support being at, let's say, just above 56, if that breaks, we'll be looking for a move down to that $54 level. But still bearish view here on this sector, because even though yields are higher, recessionary fears are really going to impact banking names. And for that reason, I do think there's potentially more downside with this technical level of 60 holding as resistance. Okay, so moving on to some bullish market observations. I actually only have 2 for today, but this is a pretty interesting one. Carnival, cruise line operator, and look at the price action on the weekly time frame. We saw the pandemic naturally have a huge impact, a huge negative impact on Carnival. And price moved down all the way from around $52.50 to just below $10 a share, which is, a significant move lower. It did try to recover during the partial reopening, but has since now moved lower. Obviously, recessionary fears played a big part there. But, you have to ask yourself, for cruise line operators, right now is still a better time to be operating than, during the pandemic drop. And right now, price is trading at the same level of the pandemic drop when everything halted. So for that reason, I actually think Carnival is a very good long-term play. It's still going to benefit from this reopening that we continuously experiencing. And it's very cheap, just under $10 a share. It's reacted to that support level at just below 10 and starting to move higher here. So with some decent momentum. So this will be a longer term type of trade. The type of strategy I'd probably use for this one would be a call diagonal, where you buy a long-term call option and you kind of sell shorter dated call options against it to reduce the cost basis of that more expensive, further dated long call. And I'll be looking for, I think there's potential, plenty of upside. And I'll be looking for, even a revisit back to the $30 level over the next few months here for Carnival. Taking a look at NIO, so electric car manufacturer based in China. So we are seeing a bit of a diversification away from the US, which is why I do like NEO. And if we take a look at the price action, the Chinese stocks have been doing quite well over the last couple of months, but we have seen a bit of a pullback there, especially even within their tech sector. So we saw a strong move higher after fighting support at 12, running into resistance at 24. And we are seeing a classic pullback with very little bearish momentum. So we have a strong impulse move, a bit of an exhaustion move down, finding support at 20. It's 55-day exponential moving average as well. And, I think now is a good entry point, even though yesterday's price action wasn't exactly bullish. I'll have a medium-term bullish view on NEO, possibly targeting 60 to 90 days out, and probably be looking at a core vertical, buying a core vertical here. Potential resistance, obviously, at 24. But from there, the next area of clear resistance, if we can pass 26, would be at 32. So significant upside potential for NEO, and buying a core vertical would help limit that risk as well. We're moving on to some bearish market observations. First is Monster. So Monster is now at a major resistance level. If we take a look at the weekly time frame, at around that 98 to 100 level, you can see on multiple times price has rejected that level. And even more recently, last week it did reject that. This week moving lower quite significantly. And even though it's part of the staples sector, and I generally have a more positive outlook for the staples sector, we are seeing an initial rotation out of staples over the last couple of weeks. So from a timing perspective, I think I do like this trade. It is set to open a little bit higher this morning, last time I checked. So the further higher it moves, closer to that 98 area or 99 area, the better the risk to reward bearish entry point. The minute it breaks above this line, I'd be looking to potentially close that trade. But overall, a very good entry point here, I think, for Monster. Moving on to Horton. So Horton is an earnings play on a home builder name. So we did speak about home builders a bit earlier, but what I like about Horton, ahead of earnings, is the fact that it's actually popped up quite nicely ahead of earnings. We saw that move higher in home builders in general after Lennar posted its earnings numbers. So, and that being said, I think that upside surprise has therefore been priced in. So it would have to be a significant upside surprise here for earnings in the next couple of days for price to actually break above that $76 area of resistance. And overall, the home builder sector, though, is still experiencing poor fundamentals. We have recession fears, higher rates means less new homes. We're seeing evidence of more cancellations within the industry. So, like I said again, it would take a significant upside surprise at earnings to see this resistance level broken. And from a risk reward perspective, I do like it for a bearish earnings play, potentially for a move lower. Okay, taking a look at Dexcom. So Dexcom did have a stock split a couple of weeks ago, and this is really a short-term play. I like keeping trades, doing short-term trades in this type of market when there's so much uncertainty and so much systemic risk. Kind of getting in and out of a trade very quickly and kind of taking your profits as quickly as possible. It definitely seems to be the best strategy for this type of environment. So we have a strong move lower. Price did find support at 68 or so. And price is now running into resistance at around that $80 level. And this is all about playing the range. We had some bearish price action even yesterday. So from a timing perspective, I think it's a good time to enter a bearish setup here. But I would probably want to get out just before earnings unless you're comfortable with holding it till earnings as a bearish earnings play. And taking a look at Apple as a bearish play. So again, the reason that the major indices actually moved lower yesterday was because Apple said they were slowing down their hiring process. So it had a very negative impact on the major indices. And we can see here Apple, even though it's set to open a little bit higher, not that much higher, it is running into resistance at around that 150 area. And again, another short-term bearish play for a potential move down to 140, which has acted as a key area on the weekly time frame as well. And that'll be the initial target. But if it breaks below that, you're potentially looking at around a 135 secondary target here for Apple. You just have to be aware of earnings as well in the upcoming days. And with that, that is all I have for you today. Thank you so much for joining me. And I hope you all have a great trading week. I will see you next week. Thank you.